Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. If you have some last-minute Christmas shopping to do, we have some really nice discounts on our home study programs for all different levels of investors. You can find out about that at investors.com/investingshow.
And this week, in the spirit of the holiday season, we're going to use Scrooge and Santa to take a look at a couple of stocks. We think it'll be fun.
But first, let's take a quick look at the market.
It has been a volatile week in the market. Stocks rallied before the Fed met, and as expected, they raised rates by 1/4 point. Now, the market reacted positively at first, and it certainly likes the certainty in the market of knowing what's happening with the Fed.
Didn't like much else, though, after that.
Not after that. It looked really pretty bad. Thursday and Friday, the market sold off in a brutal fashion with the indexes reversing sharply.
Right, so it was just another round of that seesaw action, which is really reflective
just on a
of,
teeter-totter.
We've seen it all year long, and unfortunately we saw it again. Now, here's the S&P action for this week. On Monday and Tuesday, the market moved up in anticipation of that Fed meeting on Wednesday. And when Janet Yellen raised the rates, as you mentioned, the S&P jumped almost 1.5% on volume that was higher than the day before. So that prompted the outlook in the market pulse to change to market in confirmed uptrend. Now, this was considered a rare follow-through day on the third day. It's usually the fourth day or later. But with any new uptrend, you want to test the waters carefully because not all follow-through days work. And on Thursday and Friday, the index is reversed and sold off.
And the other problem is there were no quality breaks out, which made this follow-through day suspect. But the expectation would have been that you should have seen breakouts on Thursday and Friday following the follow-through day, and instead what we got was more heavy selling. A quick look at the indexes here shows clearly that the trend was changing, and it was not a positive one. It was quite negative.
That's right. Now, it's a good point about the lack of breakouts because having a follow-through day is just one piece of the puzzle. You also have to have something to buy. In order to have something to buy, you have to have those quality stocks breaking out. And we just really didn't have that. And that means the chances of a follow-through day failing are higher.
Much higher. So shares of Apple also had a tough week. Morgan Stanley cut its price target, citing slowing iPhone sales. The stock dropped down to the $110 level, but then it continued to drop, especially as the market sold off, down to about the $106 level, and the heavy volume showed the institutional selling.
Now, the action in Monster here, it represents the selling pressure and the frustration that we've seen recently. The stock broke out in late November, but it couldn't make any headway. Then it reversed lower the last 2 weeks on rising volume. However, it did find support at the 10-week line. So it's not a clear, decisive break, but on the other hand, that attempted breakout failed. So there's been a lot of that this year, and it really does make it challenging for growth stock investors.
It does. Now, oil also dropped below $35, and U.S. active oil rigs rose for the first time in 5 weeks. And a little tidbit of information, this was the Dow's most volatile December since 2008. Now, a few notable names that we'll report include Nike, Walgreens, Constellation Brands, and Acuity Brands. And you can find a list of stocks that are due to report in IBD every Monday in the Monday edition.
And as we all know, Nike has had a great year, but it's now under that 10-week line. So we'll see if the year for Nike ends with a bang or a bust.
All right, the market continues to be difficult and leadership is narrow. Caution is a good thing right now in the market, but continue to do your routine and keep your watch list up to date.
So in honor of Christmas, we're going to see what kind of investing lessons we can learn from both Santa and Scrooge, and then we're going to have both of them review some of today's leading stocks.
And as we look at these two characters, we might get some surprises.
Yes.
You know, we think of Santa as being jolly and fun. He brings gifts to all the children, favorite toys.
All the good ones, anyway.
Yes, all the good. We think of Scrooge as the bad guy, the curmudgeon, you know, the tightwad, the guy that won't spend any money. He's not generous. But a closer look may reveal some surprises.
Yes. So let's take a look at some of the pros and cons, the strengths and the weaknesses of how Scrooge and Santa might behave as investors. And let's start with Santa. One positive trait is that he keeps a list and he checks it twice. So this is crucial for us as investors. Finding winning stocks and buying them at the right time does start with keeping a good watch list.
Now, another great thing about Santa is that he buys the most popular toys that are in big demand. And as investors, we look at supply and demand, and we look at big volume as an indication that a stock is in big demand by the consumer.
That's right. Now think about it. If Santa decided to save a few bucks and only buy last year's hot toys that are stuck in the bargain bin, right? There would be a lot of disappointed kids on Christmas morning. And it's the same with investing. We want to focus on companies that are driving something new and stay out of that discount counter.
Definitely. Now, Santa is so well loved because he delivers what everybody wants. Now, the best new toys are out there. I remember when Tickle Me Elmo was huge, or the Beanie Babies, or the Cabbage Patch Kids. And this year, it's the hoverboards. Well, we want to be in stocks that everybody wants. And those that in the last quarter of the year certainly have been stocks like Amazon, Facebook, Google, and McDonald's.
Now, another positive trait of the Wall Street Santa is that he puts bad stocks on the naughty list. Of course, just like the naughty kids, they can turn around and become good stocks again. But for the time being, when that chart isn't acting right, they're going to get no gifts from the big guy from the North Pole.
Now, the nice list are the A-plus stocks that we're looking for. Now, whittle down your watch list to the best of the best if you can. But Santa, here's a negative. Santa's prone to rushing. He's got a tight schedule. He's got to deliver packages on time. He's all over the globe. So if you're pinched for time, you have to make a little bit of a regular routine, no matter what, if it's 10 minutes a day, so that your stock picks aren't made in a flurry. Now, plan your trade and then trade your plan.
And here's another downside for Santa's approach in that he may stuff too many stocks into his bag. Now, diversification is not a bad thing per se, but if you own too many stocks, it can dilute your overall gains and make it more difficult to track each one, which could mean you're going to miss a key buy or sell signal.
Now, because Santa shops sometimes at the last minute in order to get that great toy, he also overpays. This is when the elves are too busy and he's got to go get other people to help him with his shopping list, okay? So with investing, you don't want to chase a stock and then pay too much for it. You know, try to be a little bit more disciplined than Santa and buy as close to the pivot as you can.
So now let's switch gears and talk about Scrooge, who generally gets a bad rap, but he does have some positive investing traits.
He does.
And one of them is that Ebenezer is old and he's crusty, but he is disciplined. He sticks to his rules and routines, and he doesn't get caught up in all the latest hype. And he can also be quite contrarian, and all of those things can be positive as an investor.
Now, he's thinner than Santa, who tends to overindulge on the eggnogs and the cookies. So try to jump on every opportunity in the market. If you try to do that, it can be intoxicating. It can be like a little bit of extra eggnog.
And dangerous.
And dangerous, but it can get you into trouble. Now, Scrooge, in many ways, is more picky than Santa, and he doesn't overpay. He's quite the little tightwad.
I haven't heard that term in a long time. Now, also, Scrooge makes sure that he doesn't take on too much risk. To grow your money, really the first step is protect the money that you already have. So being risk-averse like Scrooge is a positive unless you take it too far, as Scrooge sometimes does.
He does. But Scrooge doesn't buy enough. He's too cheap, and he doesn't want to add to his positions. So if you have a stock that's working for you, you want to incorporate pyramiding, which is the concept of adding to positions that are winning, your winners that are doing very, very well. You're also going to add to your winners as they break out of new bases or 3-week tights or the first couple of pullbacks to the 10-week line.
Now, here's another negative attribute for Scrooge, and that is he remains stuck in his ways. He doesn't like new things, which means he's likely going to miss those new market leaders, the young, innovative companies that emerge at the beginning of every single bull cycle. And since he's reluctant to adjust those habits, even when they're not working for him, it takes some pretty dramatic events to make him change.
And his bah humbug ways wreak havoc as the ghosts of the past, the present, and the future haunt him. So what ghosts from the past haunt you? Now, don't beat yourself up over past mistakes in the market. And in the present, are you doing the best job that you can? Are you sticking to the rules? And as for the future, Scrooge does redeem himself. and he realizes that he can do a better job. So as investors, as we head into 2016, what things can you do better? Make yourself a nice list and then keep it.
So let's take a quick break, and then we're going to see how Santa and Scrooge might review some of today's leading stocks.
An edge that helps you pick winning stocks faster. An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
All right, so now that we have dissected Santa and Scrooge as investors, let's take a look at what they would say about market leaders Disney, Amazon, and Facebook.
Now, Star Wars opens this week. My daughter and I have tickets to go see it. And along with this highly anticipated movie, which is going to set box office records probably around the world, comes merchandising. And it's expected to sell $5 billion next year. You know, Matt, I was looking at the Ralph's flyer. It comes in the mail. Ralph's is a grocery store chain out here in California. And the Star Wars images are on all kinds of products. It's on soup. It's on crackers. You name it. So this illustrates big demand. Santa is going to be delivering a lot of Star Wars toys this year.
Yes, he is. Now, after making a huge run, Disney stock pulled back into a deep base. As it was regaining its strength, Santa might have looked at all that new revenue coming into the company's coffers and been encouraged, especially since it reset its base count earlier. But Scrooge may have thought it had already had its big run and it was now overpriced. And Scrooge got his I told you so moment when Disney sold off sharply. Now, while Santa probably moved the stock to his naughty list for now, it might turn around in a better market.
Now, Amazon is certainly a place where Santa would be shopping. Again, when the elves just can't quite...
Just stay at home. Why get in that sled?
So he doesn't have to face the busy malls. He can use Amazon Prime Now, which gets delivered within an hour or two if you join.
Yeah, I used it the other day for the first time. We were going on a trip the next day, and we needed a Bluetooth speaker for my kids. Ordered it, hour and a half later,
it was
it's
at
on
your
my
doorstep. That's really amazing. Now, people with busy schedules, you know, Amazon has just become a giant in the e-commerce business. Now, Scrooge might keep his old shoes, but we know from Amazon's anticipated growth next year that many shoppers are going to their website.
And that's just one part of the business for Amazon. It also has that very fast-growing cloud business, Amazon Web Services. So it clearly continues to be an aggressive, innovative company. Now again, since this stock has already made a big move since breaking out in April, this is one that Scrooge would probably avoid. But we all know that Scrooge loves money, and he may be tempted because Amazon is profitable again with 2 straight quarters of triple-digit gains.
Now, Facebook is another company that Santa loves. He has lots of friends on Facebook, and people can post what they like or what they don't like. They can like him. So people can track where he is by watching his sleigh on this particular site. But Scrooge would say, just the same as Disney, Hey, Facebook's already had a new high, in recent weeks. It's a huge company. It's already made a big move. So Scrooge would probably be a little bit bah humbug on this stock.
Right, but there's nothing bah humbug about how Facebook is monetizing its properties and it's over 1 billion monthly active user, which is really an insane
Huge.
number
It's
if you think
huge.
about it. And mobile ad revenue is on the rise. Instagram is generating good revenue now. And they haven't really even begun to tap into the monetization of the Messenger app, which is a platform in itself. It has over 700 million active users.
Those numbers are just a little hard to wrap yourself around. Those
They really are.
huge numbers. So Facebook isn't a flat base. This is a weekly chart. Currently, the structure is nice and tight. I have covered this on the Stock Market Today videos. It has a strong up-down ratio, which shows positive demand for the stock. So are you Scrooge on this stock, or are you in Santa's camp? Santa probably has the edge here, but only time will tell.
Yes, indeed. Now, so that is a lighthearted look at some of the key rules we can learn from Santa and Scrooge, but the points really are important to all of us as investors. Staying disciplined, avoiding excessive risk, and focusing on new, innovative industry leaders can make for a very happy new year.
We want to wish all of you a very, very Merry Christmas, Happy Holidays. We hope you have a wonderful time with your families and the people that you love, and we will see you next week.